So till the previous session we completed basic earnings per share. Today we will start diluted earnings per share. Now when we talk about diluted earnings per share, what we are saying is our EPS goes down because there are new shares. Now these new shares are not existing shares, these are potential shares. For example, there is a convertible debenture. Now when there is a convertible debenture, can they become shares in the future? Yes, they can become shares in the future. If they become shares in the future, the existing EPS is going down. Sir, how will the existing EPS go down? See, when the debentures are converted, two things will happen. One, there is savings in interest. Second, number of shares will go up. So you have a saving in interest and the number of shares that we're talking about, it goes up. Now savings in interest will also increase my profit. But if you say, for example, existing profit is 1000 and shares are 100, because of this savings is 100, but number of shares that will go up is 50. So you have 1100 and here you have 150. So earlier it was 1000 divided by 100, that is 10. Now it will become 1100 divided by 150, that is about 6 point something, right? So here, because of this, my EPS is going down, and that is where we have this diluted earnings per share as a concept. Okay. Now, how do we calculate diluted earnings per share? What you have to do is you take the earnings as per your basic EPS. To this you add savings in interest, or if preference dividends are there, if there are convertible preference shares, then preference dividend that you will be saving, whatever is there, that you will add, divided by number of shares original plus potential. So that is how we calculate diluted earnings per share. But please remember one thing, you will calculate diluted earnings per share only if after the potential shares are considered, the EPS goes down. If the EPS goes up, sir, how will the EPS go up? Maybe for example, interest savings is 1000. Then in that case, EPS will go up. So if EPS goes up, then you will not call them dilutive, you will call them anti-dilutive. So the way you will calculate is the profit or loss attributable to equity shareholders when potential shares are converted, and weighted average number of equity shares plus weighted average number of dilutive potential equity or ordinary shares. So the way we calculated basic EPS, using the same principle, we will calculate weighted average number of dilutive potential ordinary shares. Potential means they will become shares in the future. They are not shares now, they will become shares in the future. Now here, dilutive potential ordinary shares are deemed to have been converted into ordinary shares at the beginning of the period or the date of issue, whichever is later. So when we talk about weights, you have to take this timeline. Let us say this is April and this is March. If there is something which is issued prior to this, convertible debentures were issued prior to April, or anything which was issued before the beginning of the year, you will assume that on this date they will become your potential, they will become your ordinary shares. Whereas if something is issued in between, if something is issued here, then in that case from here till here, let us say 9 months, we will consider 9 months for the purpose of calculation of weights. Okay, so that is first. Then if potential ordinary shares are cancelled or lapsed during the period, they are included till the date or for the period for which they are outstanding. If something was cancelled during the period, if they are outstanding only for 3 months, we will consider from the 3 months period. Okay, then if potential shares are converted during the period, means it was convertible preference shares at beginning, during the period they got converted, then what will happen? From the date of opening, let us say April, let us say till June, this period will consider for dilution, and from this period onwards this becomes calculation for basic earnings per share. Okay, so after the conversion they will be considered for basic earnings per share. When you consider for basic earnings per share, automatically in the formula for diluted earnings per share also it will be considered. Okay, now sometimes what happens is, we'll see a question, there are multiple conversion options possible, number of shares based on the period and all of that. You have to see which is the most advantageous from the point of the holder. Means when will the holder get maximum benefit? That should be the assumption when you're saying that, okay, I'm calculating the potential number of shares. Okay. Only when they're dilutive, we will consider. If they are anti-dilutive, we will not consider. Now, sometimes what happens, there could be more than one potential ordinary share. Let us say you have debenture, then you have, let us say, preference shares which are convertible, then you have, let us say, ESOPs and all of that. Okay. Now, what you have to do is, you have to calculate, because of debt, what is the earnings saving divided by what is the number of shares. Like this, for each category you calculate what is the potential earning or savings divided by number of shares, you will get EPS. You will get EPS. Now, when you got that EPS, what you have to do is, you have to see which one is most dilutive. So, if let us say debt gives me 2, preference gives me 2.5, ESOP gives me 0, for example. Okay. Now, if this is the scenario, then most dilutive is ESOP, because number of shares have increased but profit has not increased. So ESOP is most dilutive. We will first take this, then calculate the dilutive earnings per share. Then you will see whether conversion of debt will make it dilutive. Then you will calculate dilutive earnings per share, and accordingly you will continue. So what I mean by that is, for example, my basic earnings per share is, let us say, 3. ESOP will give me 0. Debt will give me, let us say, 2, and preference shares will, let us say, give me 4. Now, when I see this is less than 3, so this is definitely dilutive. You include ESOP and calculate basic earnings per share. So now, let us say basic earnings per share is 3000 divided by 1000. ESOP, when you consider, the dilutive earnings per share is 3000 by, let us say, 1500. Okay, so this became how much? 2. This became how much? 3. This is basic earnings per share. This is diluted earnings per share. Let us say this is 2.5. When you convert debt, it becomes 2.5. Now, my current diluted is 2. If I convert debt, they have a higher EPS than current EPS of 2. Means this is anti-dilutive. When you started at 3, this was also dilutive. But after considering this ESOP, this becomes anti-dilutive. If this becomes anti-dilutive, then you will not consider this for the purpose of calculating diluted earnings per share. So, when there are multiple EPS, then you will say the one which is the most dilutive, and then in the reverse order you will start working. So first, what will you do? You will see what is the incremental EPS, that is effect of the potential share on the earnings to equity shareholders and on the weighted average number of shares. Then you will do the ranking. Then calculate diluted EPS. You will calculate diluted EPS at each stage. Once the diluted EPS starts reversing or increasing, then you will stop at that point of time. Okay, so that is how we calculate diluted EPS. So what we'll do is, we'll take few questions from the material that will improve our understanding of diluted earnings per share. ABC Limited has ABC Limited has 1 lakh, 10 lakhs 1 ordinary shares and 10% convertible bonds issued at par, each converting into 20 ordinary shares on demand, all of which have been issued for the whole of the reporting period. So here what is there? Here they are saying there is 10 lakhs, 1 rupee ordinary shares and 1,100 rupee, this is the face value, 10% convertible bonds. They can be converted into 20 ordinary shares. So 1000 into 20, you will get 20,000 ordinary shares. ABC Limited share price is 4.5 per share and earnings for the period are 5 lakhs. Tax rate applicable is 21%. Calculate basic and earnings for incremental shares and diluted EPS. How is the basic earnings calculated? 5 lakhs is the earnings. Number of shares, how much? 10 lakhs. So 5 lakh divided by 10 lakh, the basic earnings per share is 0.5. Right. Now, what is the impact of conversion? See, we have 1000 shares of, 1000 bonds of 100 each, that is 1 lakh. On this 1 lakh, we pay 10% interest, that is 10,000. On this 10,000, we save 21% of tax, which is 2,100. So my net expense is 10,000 minus 2,100, that is 7,900. Or what you can do, 10,000 into 1 minus tax rate, you can directly calculate the savings. Now my savings are how much? 7,900. My savings are 7,900. Then what are they saying? They're saying each is convertible into 20 ordinary shares on demand, all of which have been issued for the whole of the reporting period. So each one, 1,000 will give me, 1,000 bonds will give me 20,000 shares. 1,000 will give me 20,000 shares, right? So now 20,000 additional shares is what I'll get, and 7,900 is incremental earnings. 20,000 is the shares. That is, so if you do 7,900 divided by 20,000, you get 0.395. You get 0.395. Now, my current earnings is 0.5. My revised earning is 0.395. Means my incremental earning means if I convert the shares, my EPS will go down. If my EPS will go down, what is my revised EPS? My revised EPS is earnings for basic EPS 55 lakhs plus 7,900 divided by 10 lakhs plus new shares 20,000. So that this calculation gives me 0.498. Okay, there is how it is calculated. Now, for example, if this said that they are convertible into 10 shares, then here your working would have been 7,900 divided by 10,000, that is 0.79, which is anti-dilutive. Why anti-dilutive? Because this will ultimately increase my current earnings per share. I hope the concept is clear. Okay. Now let's look at this one. This is also an important question. At June 30th of year 1, the issued share capital of an entity consisted of 15 lakhs ordinary shares of rupees 1 each. On 1st October, entity issued 12,50,000 8% convertible loan stock for cash at par. So it's a loan stock, 8% convertible. Each 100 nominal value, so this is total value, each 100 nominal value of the loan stock may be converted at any time during the year ended 6 to 9 into number of ordinary shares set out as below. So 1,250,123, this is the total value. Each, if you take 100 into, if you convert on 30th of June, you get 135. Like this, if you convert on 30th of June of year 7, 130, 125, 120. Okay, we are on which date? We are in June year 1. So our calculation will be as on what they have said, 30th June. Year ending is 30th of June, right? So this is the subsequent conversion given. If the loan stocks are not converted, they would be redeemed at par. So if they don't convert, they will be redeemed at par. It is assumed that the return equity conversion option is accounted for as a derivative liability and marked to market through P&L. Now this you will understand as a part of India's 109 financial instrument. So they have considered it to be a derivative liability, and whatever is the gain or loss on the fair value, that is taken through P&L. The change in the option fair value reported in year 2 and year 3 amounted to losses of 2,500 and 2,650. It is assumed that there are no tax consequences arising from these losses. So there are losses, MTM losses, you will not get any tax benefit out of it. The profit before interest, fair value movements and taxation for the year ended 30th of June year 2 and year 3 amounted to 825 and 895 and relate to wholly continuing operation. Rate of tax is 33%. Calculate basic and diluted EPS. Basic EPS is very straightforward. Take the profit minus interest on 8% loan stock. When did we issue? We issued on 1st of October. So for 9 months only we have to provide for interest in the first period, that is 75,000 and 1 lakh. Okay, then there is a loss due to fair value of embedded option 2,500 and 2,650 as given in the question here. So this loss also is taken to P&L. Then profit before tax is given. Taxation at 33% on A minus B. Why only A minus B? Why only this minus this? Because this does not have any tax consequences. So tax is so much, profit after tax is given. This divided by number of shares, 15 lakhs in each of the case will give you the basic earnings per share. Now when it comes to diluted earnings per share, what we need to understand is, if this is converted, if these are converted, the loan stock, then I don't have to pay interest. There is no fair value loss that will be recognized. I don't have to pay interest and there will be no fair value loss that will be recognized. So basically, I will have profit of 895 and 825 minus 33% of tax. So if I do 895 123 into 67%, what I'll get 599 650. 599 650. Okay, that's how we can calculate. Or you can take 530 in exam. Follow this approach. Take 530 profit after tax. Add what will I save if the loan gets converted? I will save this change in fair value. So this loss will no longer be there. Add that. Then add this interest 1 lakh. Net of tax, that is 67%. When you do that, this 67 plus 2650. If you do that, you get 599 650. Here also you can do the same thing, 552 750. Just that interest is only for 9 months and not for the entire year. Okay, so my adjusted earnings for checking diluted earnings per share is 599 650 and 552 750. Right now, depending on the period, the conversion number changes. Which one should we consider? We should consider the highest conversion possible. So what is the highest conversion? 135. So you'll take 135 for calculation. So if you take 1250, so basically 12,50,000 divided by 100 into 135. If you do, so basically 1250 into 135, if you do, you get 168,750. 168,750. Right. So now this 168,750 is what is your maximum conversion possible. Here also it is 168,750, but only for 9 months. So this is the weighted average number of shares. Take existing shares, add maximum conversion, you will get revised number of shares. Adjusted earnings, your diluted EPS is 19% and 20%. Now this, please cross check here, it is 35 and 33. So in both the cases it is dilutive. In both the cases it is dilutive. Right. So that is how we will calculate diluted earnings per share. So you will take earnings as you have used for basic earnings per share, add savings, how net of tax, you will get revised earnings, that you will divide by number of shares which you have used for basic plus diluted. If the EPS after conversion increases, it is not dilutive, it is called anti-dilutive. In the examination, to check, what you can do is you can take the total number or total earnings divided by number of new shares. Increased earnings divided by number of new shares, that will give you the diluted earnings per share. Okay. Now, some specific aspects that we need to understand here is that whenever we have options, warrants or similar things, warrants means you have given some instrument to the other party can pay some amount and other party can get some shares. So these are potential shares. Now whether they are dilutive or not, for that what we need to check is what is the issue price versus what is the average market price, or sometimes we can also refer to the fair value. Okay, so for example, from this warrant, 90 is the issue price, market price is 100, average market price is 100, which means what? Something worth 100 I am giving for 90. So to the extent of this 10, we will say these are free shares and these are dilutive. For the portion of shares for which you have collected the amount, that is not dilutive, that is not dilutive, that is not anti-dilutive either. Okay, meaning to say, whatever is the difference between the number of ordinary shares issued and the number of ordinary shares that would have been issued at the average market price shall be treated as an issue of ordinary shares for no consideration and should be included in the calculation of diluted earnings per share. So what it basically means is, for example, if there are 1,000 shares, and at what value will I issue? 90. So how much is the amount? 90,000. I would have collected 90,000. But if this amount was collected 90,000 and if I had done issue at average market price, number of shares I would have issued is 90,000 divided by 100, that is 900 only. So 100 shares will be considered to be anti-dilutive. will be considered to be dilutive. Remaining shares will be ignored. I am repeating once again. The number of ordinary shares that would have been issued at the average market price and the number of ordinary shares issued, actually the difference between that will be considered to be the dilutive portion, and that will be added to the denominator. Okay, now if my issue price is less than the greater than the average market price, then it is not included or it is not considered. So for share, options and warrant, what you need to check? You need to check number of shares that we have issued minus, for the same amount at average market price, what would have been the number of shares that I would have issued? The difference between these two will be considered to be the dilutive portion. Then employee options, right? Now for employee stock options also we have, where you have stock options to be issued to employees, right? Now this is based on two types of condition. One is the service condition, that is as time passes it is vested. Second one is performance condition. If it is performance based employee share options, they are contingently issuable shares, and hence that is not separately treated for diluted earnings per share. So you will treat it as if they are contingently issuable shares. And when will we include that in calculation of EPS? If the contingency is satisfied. Right? Then if there are share options with fixed terms and non-vested ordinary shares, they are treated as options, like what you have treated as options and shares warrant in calculation of the earnings per share. So they may not serve us 2 years period, but still we'll assume as time passes, employees, there will be vesting, employees will get those shares, and hence it is a dilutive shares. How do we treat it? We treat it based on the same manner that we have treated option pricing, right? So previous whatever we understood as a part of option and warrant, same thing will be done. Now if there are ESOPs, you will take the total ESOP minus exercise price into number of options divided by average fair value. Here also what is there? It is exercise price. How much will we get into number of options? How many options are there? Divided by average fair value. Means how many shares would we have issued and how many shares that has been issued. Hence, and the difference between those two will be considered as dilutive component. Okay. If there are contingently issuable shares, then you will not include them in calculation of the basic or diluted if the contingency have not happened. Contingency have not happened. Okay. Now, if the contingency has occurred, you will consider in basic. Okay. So the summary here is, if the conditions are not satisfied, no treatment. If the conditions are satisfied but shares not issued, consider in both basic and dilutive. Consider means what? Include. Conditions are satisfied but compliance date is future, means conditions are satisfied but we will issue in future, then it is dilutive. If conditions are satisfied and shares have already been issued, you will consider in basic EPS. Automatically it gets included in diluted EPS as well. Okay, so these two are similar, and this one, if it is in future, it will be considered to be diluted EPS. If the entity has discontinued operation, then when the entity reports a discontinued operation, we should use income from continuing operation adjusted for preferred dividends and similar adjustment in determining whether potential common shares are dilutive or not. So for discontinued operation, we will only take the continuing operation part and check whether they are dilutive or not. Okay. So this we have to, yes. And if there are contracts that may be settled in ordinary shares or cash, you will assume that it will be converted into ordinary shares, and you will include them in dilutive earnings per share if the effect is dilutive. Okay. Now, if they may be settled in ordinary shares or cash at the holder's option. So if it is entity's option, what will you do? You will take the conversion and you will present diluted earnings per share. If it is at the holder option, you will see which one is more dilutive. Okay, which one is more dilutive, accordingly you will calculate. So you will see which one is more favorable for the holder, and accordingly you will include it in the calculation of calculation of EPS. Then if we have purchased option, now purchased option means company has purchased put option or call option on its own shares. this will not be included, because what will happen is, if it is a call option, for example, if I have purchased a call option is one option to buy. When will I buy? I will buy if my exercise price is less than the market price. So if I am buying back at a lower price, it is anti-dilutive. I am making benefit. Okay. Same way option to sell also. I will sell only if the option to sell it at a higher price, and hence this will not be considered. So purchase option, no treatment. Then return put option. Return put option means what? The entity has return put option. That is, the entity has agreed to buy back. The entity has agreed to buy back from the shareholders. So return put option is where the other party has an option to, give the shares back to the entity. That is called a return put option. Now, in case of return put option, what we need to understand is, the entity will repurchase its own shares when you have a return put option or forward purchase contract, and it will be included if the effect is dilutive. It will be included if the effect is dilutive. Now, when will the effect be dilutive? If the exercise price is above the market price. So, because I'm agreeing to buy, the other party will sell only if the exercise price is above the average market price. Means the exercise price, the price at which the other party will sell, is above the average market price. At that point is when you will have that transaction being executed, right? Now, how to calculate this? Now, to calculate this, what we'll say is, let us say average market price is, let us say, or I'll take the example in the institute itself instead of constructing. Sometimes calculation becomes tricky. So let us say an entity has 160 return put option outstanding on 160 of its ordinary shares. So 160 shares they will buy back at an exercise price of 10. Okay. The put obligation is therefore 1600. So this is worth 1600. I have to give 1600. I have to pay 1600. Now to pay 1600, what we will assume is that we will get this 1600 by issuing shares. We will get this 1600 by issuing shares. Now at what price can I issue the shares? I can issue the shares at 8. So what I will do, to collect 1600, I have to issue 200 shares. So the way the sequence works is, 200 shares I will issue at 8, collect 1600. Using this 1600, I will buy back 160. So I issue 200 shares. When I buy back, I will get only 160 shares. The difference between these two, 40 shares, this is considered to be dilutive. So when I say this is dilutive, this is added to denominator. No treatment in numerator because there is no change in profit. Just that because I am buying it back at a price higher than the market price, that is when this scenario will happen. So what if the buying price is lower than the market price? Then in that case, what will happen is the other party will not sell. The other party will sell it in the market. The other party will not sell those shares to me. Okay. So that is when it is in the case of your return put options. Now, some retrospective adjustment. If there is a bonus issue or share split or reverse share split, then the basic and diluted EPS for all periods shall be presented retrospectively. Okay, retrospectively. Then, even if these changes occur after the reporting period, but before the financial statements are approved for issue, it will be based on the new number of shares only. And to give impact of all errors and adjustment resulting from changes in accounting policies, they are also accounted for retrospectively. Okay, so that is how you will do the treatment. Now, if there are two class ordinary shares, so if there are two class ordinary shares, then what will happen is you will have to adjust. You will have to adjust the EPS with respect to the rights to dividend. So, if there are certain instruments that participate in dividend with ordinary shares according to a predetermined and upper limit in some cases, so based to the extent of their participation, you will see how do you calculate. Okay, then what you will do, you will allocate the profit to the different classes of shares and participating equity instruments in accordance with the dividend rights or other rights. So what you will do is, based on the dividend rights, so let us say one category of shares gets 2/3, other categories of shares will get 1/3. of in proportion of dividend, or profit will be distributed in the ratio of 2:1, 2 portion to the first class, 1 portion to the second class for calculation of earnings per share. Then how do we present it? You will present it in the statement of P&L, basic and diluted EPS, and you will give them with equal prominence, means both of them will be presented on the face. Even if it is negative, it will be disclosed on the face of the profit and loss, and that is how you will make the presentation. Okay, if there are no potential shares, then the EPS is both basic as well as diluted, so you don't need to present it on two different lines. Right, so now we'll look at one more question. On two class shares, entity has two class of shares in issue: 5,000 non-convertible preference shares, 10,000 ordinary shares. Preference shares are entitled to a fixed dividend of 5 per share before any dividends are paid on the ordinary shares. Ordinary dividends are then paid in which the preference shareholders do not participate. Each preference share then participates in any additional ordinary dividend above 2 at the rate of 50% of any additional dividend payable on an ordinary share. So what does that mean? First you have to pay 5, then above 2. So whenever you are paying it to the ordinary shareholders, after 2, 50% has to be paid to the preference shares. 50% will be paid to the preference shares. The entity's profit for the year is 1 lakh and dividends of 2 per share are declared on the ordinary shares. Compute the allocation of earnings for the purpose of basic EPS when an entity has ordinary shares and participating equity instruments that are not convertible into ordinary shares. So there are instruments which are participating, they are equity instruments, but they cannot be converted into ordinary shares. So first what will you take? The profit 1 lakh. Then dividend, how much we have to pay? First you have to pay 5,000 into 5. So you will pay 25,000 here. Then ordinary shares 20,000, 45,000. Remaining is how much? Remaining is 55,000. Now how will we distribute this 55,000? See, if I pay 2 rupees to ordinary shareholder, I have to pay 1 to preference shareholder. If I pay 2 to ordinary shareholder, I have to pay 1 to preference shareholder. But please note here 5,000 and 10,000. So numbers are also different. So if I pay 10,000 into 2 to the preference shareholders, I will pay 5,000 into this to ordinary shareholders, I will pay 5,000 into 1 for your preference shareholders. Okay, so this will become 20,000 here and 5,000 here. 20,000 to this category, 5,000 to this category. Okay, that is how we can calculate. So now if 20,000 and 5,000 is there, if 20,000 is 5,000 is there in that ratio, if I have to distribute 55,000, this 55,000 has to be distributed in the ratio of 20:5 or 4:1. Okay, 4:1. Now, if I distribute in the ratio 4:1, then 55,000 divided by 5 into 4. So 44,000 will be to equity, 11,000 will be to preference. 44,000 and you have how many of them? 10,000 of them. So this is 4.4. And 11,000 you have 5,000 of them. This is 2.2. So preference shares, ordinary shares gets added by 4.4 and preference shares get added by 2.2. That is one way to solve. Other way to solve is assume we will pay A to preference shares, ordinary shares, and B will get 50% of A. So A into 10,000 plus 50% of A into 5,000 is 55,000. When you separate it, you get A as 4.4. So A will get maximum dividend of 4.4, B will get maximum dividend of 2.2. So the EPS will be accordingly adjusted, 5 plus 2.2 and 2 plus 4.4. If there are partly paid shares, you will consider fraction. So based on an appropriate fraction, you will consider for calculation of EPS. That is a self-understood question. Okay. Now in this chapter, most important is your rights and diluted earnings per share. Sometimes you can be also tested on based on two class ordinary shares, two class shares. So based on the two class shares, you can do the calculation. Always remember, whenever we talk about diluted earnings per share, it will be in the most favorable situation for the outsiders. So when will the outsider get? That is what we'll consider. Or you see what will be the most unfavorable situation for the company. Okay. With practice, you will be able to solve more questions. I have already discussed a couple of questions yesterday and 3 questions today. Right. So that will help you understand how do we handle these kind of shares. Right, so that concludes Index 33. I'll try to share more questions which I have solved in the class as a part of a video. Not frequently tested, but very very important. If at all it is tested, it can be highly scoring as well. Thank you.